Okay, good evening, class, and welcome to our taxation class for today. We are going to be taking this topic called loss relief and good evening. Yeah, we're going to be taking loss relief and taxation of settlement, trusts, and estates. Settlement, trust, and estates. Okay, now the first one is loss relief. That's the first thing we're going to take. So let's see how it's going to work. Now, every business sometimes make loss. Now, especially in the first year of business, you are not going to be blamed if you make loss. This is because you may have spent so much on assets, spent so much on operations to make the business work. Your overheads may be high and your income and so you may make a loss on your first year. You could even make a loss on your second year and perhaps on your third year. Some people make losses for 5 years. Now that doesn't mean that the business will not make profits. But you know, those losses could discourage a small business. It could discourage you from moving on. Okay? So what do we do if we make a loss in account, in business? Now, there's what they call rules of loss relief. So we relieve our loss from our accessible profit. For a business, there's what they call carry loss or carry over loss. These are losses that you made in a line of business, but you can relieve it whenever you have profits in any year. You carry to 2011, you made another loss, you are carrying the two losses together. In 2012, you now made profits, you now clear some part of the loss. Maybe the loss is bigger than your profit, you only clear as much as you can clear. Then maybe in the next year, you make another profit that is able to clear everything. That is how it goes. So losses are inevitable. But there are rules you must follow when you are applying loss. One of them is this. Just go straight. One of them is you cannot apply relief on a loss that is more than the actual loss. Let me explain what I mean. In the first year of business, when you are starting a business, you start a business and you know the commencement rule. There are many overlap between the first year and the second year, between the second year and the third year. So during the first year, you made a loss and you carry that loss from the first year to the second year. The second year is also taking its basis period from the same period the first year took its own. And so the same loss that you've carried in the first year, you're also bringing it as a loss separately in the second year, which means you are now increasing the loss. But when you look at it, you didn't make the loss 2 times. You made the loss just once. And so we are saying that from the second year, how much are you going to carry to the third year? It's not going to be double of what you have carried because you only made the loss once. So you're only going to take the actual loss that is concerned in that period. The actual loss that is concerned in that period. In the third year, we'll look at the overlapping period between the second and the third year. And if any loss has been applied in the second year, we cannot carry it again to the third year to carry to the fourth year if you make a loss. So you see, the loss is restricted to the actual loss incurred. But if it is profit, we will normally want to pay tax double on our profit. We want to pay tax double on our profit, especially if there's overlap. But when it comes to loss, it doesn't follow that way. Let's look at a question to see how losses are being treated. The first one is Dominion Enterprises commenced business on 1st July 2001. The following are results submitted to revenue. So this is the state internal revenue. So they didn't say it's a company. That's why they didn't ask you to find tax. Now look at the profit or loss. And they told us is period ended. And I told you this is basis period. And they gave us this figure. This figure. These are losses. Now this capital allowance is for year of assessment that belongs to that basis period. It's for year of assessment. So what do we do? This is an ongoing business. They didn't, okay, and this is a startup business. This is a startup business, So this is how many period? 1, 2, 3, 4, 5 years. Now, you were told to compute the total income or loss of the business. Excuse me. We are told to compute the total income or loss of the business that is accessible for all relevant years. When they say accessible, it's the accessible profit up to the taxable profit. What do we do? Let's look at a solution. Okay. Now, this is what we'll do. In the first year, the business is starting on July 1, 2004. So this makes 2004 our first year of assessment. So 2004 becomes the first year of assessment. And so we start with 2004. And we'll say from July 1, the first date the business started, down to 31st December of that year. That is your first year. That's fine. Now, how do we calculate our accessible profit? We were given this figure. When they say period, it means from July 1, the business started, to this end of December, we were given. How much was that? 180,000. Now, that is it. It's a loss, 180,000. We're also giving capital allowance of 30,000. So you see the capital allowance is here. We didn't bring it to the next place because we are not relieving capital allowance from loss. So what happened is we are carrying the capital allowance over to the next year. And you see this loss, since you cannot relieve this loss of 180, you are taking it to the next year. Okay? Now let's go to the next year. The next year is supposed to be 2005 year of assessment. And how do we count our basis period? Once again, from the date the business commenced, we count 12 months. So there will be an overlapping between these two. So the period of overlapping here is 6 months. So what do? That period of overlapping, which is from July to December, is this 180. Okay, then we are going to take 6 months from January down to June here. So that's what we are going to do. This 180 plus 6 months of 120, which will give you 60. 60 plus 180 will give you 240. So you see 240 is containing this 180, which we have used before, and it's containing 60 that we have just used fresh. Now, that's this 240. Then we are supposed to bring this 180. So you see now, 180 is involved in this 240, and we are bringing 180 again. Is it that the 180 appear twice in our record? No, it appears once, but we've taken it twice. When you add them together, you are having 420 in 2 years. How can you use 420 in 2 years when all that you have added here, this 2, is not up to 420? The parts that you are using is not up to 420. So you see, you have to restrict it to the actual loss. What is the actual loss that you have actually made? The actual loss that you have made is, you see this 180 that is here, that you have repeated, you take 1, plus this new 60. This is the actual loss that you have made so far from when you start making loss that you have been carrying up to this moment. When you add them together, it's going to be 240. So it means that you are no longer going to carry 420 to the next year. What you'll be carrying is 240, because that's the actual loss. Now going to the capital allowance, this is the capital allowance for the year, 40,000. Okay, you have your 40,000 for the year. This 30,000 was the one balance from last year, which you carried over here, and you made it 70,000. Since you have an overall loss, there's no way you can relieve your capital allowance from loss. So your capital allowance is being carried to the next year. In the third year, which is 2006, that is when you have your preceding year basis. And you see the basis period here, as we have learned on preceding year basis. Everything still starts from when the, okay, this is not when the business started. This is from January 1 to December 2005. So you go here and check. This is January 1 to December 31st, 2005. Our answer is 120. Fine. Now this is 120 we've used here. And inside this 120, we are still bringing 240. Now, do you know that this 240 contains 180, which is okay, and just this 60 here is inside this 120. How did we get 60? It's a fraction of the 120 we did before. So it means that this 120 we made here, this 60 is also part of it. So we will not be taking 62 times. It's either we take this whole 120 and leave this 60 so that it will not be a repetition of 62 times. That's why we say the actual loss will be 180 from year 1 and 120. This is the actual loss. So instead of 360, you see 60 is the one making it a little bit bogus, a little bit more. Instead of taking 360, which is the sum of these two, we know that 60 was repeated twice. We'll take 300 to ensure that nothing was repeated. Now your 70,000 is this one here, that is the capital allowance. But for the year, you brought 40,000. Give me a moment, please. Okay, so this 40,000 is the due capital allowance for that year, plus the 70,000 we have before from last year gives us 110,000 capital allowance. And you see our loss here is a resultant effect of 300. So we cannot take capital allowance from a loss. So as we are carrying the loss to the next year, we are also carrying capital allowance to the next year. Okay, the new year, 2017, still preceding year basis from January to December 26. Now, from January to December 26, we now have a profit of 140,000. But of course, our capital allowance will be 45. 40,000. 140,000. Now, our capital, okay, now once we bring our 140,000 as profit, accessible profit, look at our loss from last year, which we carry forward, is 300,000. We are bringing it down here. So when we reduce it, we are getting 160,000 as a loss. So because we have resultant effect of loss here, it will be like that, which we will carry. Capital allowance, we have 45,000 for the year, plus 110,000 naira, previous capital allowance, which we are bringing forward. Add them together, you have 155,000, which is bigger than our loss. So our taxable profit is nil. So even though we cannot find profit here, tax from this, we can find education tax. If this were a company, we'll find education tax from this 140. But they didn't tell us it's a company, they told us it's enterprise. Education tax. Okay. Now we'll go to the next year. The next year is 2008. Can you see that this is the basis period, preceding year basis 2007? We now have another profit of 260. Now, mind you, we had a loss which we are carrying forward of 160. We now bring it here. So because we have a loss, it will reduce our upgrade. Okay? The capital allowance now for the year is 50,000, 205. Now you have 205 capital allowance to relieve, and there is 100,000 available to relieve them. What do you do? This company is not a manufacturing company. It's not an agricultural company. So we do 2/3 of our accessible profits. So we'll say 2/3 of this 100,000. That is what will be relieved. So if you know what I taught you before, the relief will be both here and here. And so this is the balance of capital allowance that will be carried to next year. Balance of capital allowance carried to next year. This is the taxable profit after relief of capital allowance for the year. So it is from this taxable profit you will pay your tax. Meanwhile, if it is education tax, you cannot pay from 100, but you have to pay from 260. That's the law. We'll go to the next year. The next year, 2009, we have a profit of 400,000. Excuse me. We have a profit of 400,000. We do not have capital allowance for the year, but we have that of last year brought forward. So when you total them together, it is this same figure. Now, can you take 2/3 of 400? When we check 2/3 of 400, it's going to give us much larger capital allowance than what we are relieving. And so we relieve this one as it is. So your capital allowance carried to next year is 0, but your taxable profit is this, 261,667. It is from here that you relieve, that you will charge your tax, and it is from this 400 you will charge your education tax. Now that's about loss relief. That's loss relief. So in loss relief, all you need to do is look at your basis period for profits, look at your capital allowance, but you should know that when you have loss, the loss that will be carried forward to the next year should not exceed the actual loss. That is the main thing to note in loss. It should not exceed the actual loss. So you be conscious of the fact that you'll be calculating the actual loss to ensure it is not higher and it is not lower than what you are carrying. We go to taxation of settlements, trusts, and estates. What is a trust? What is an estate? Now, when somebody is given a trust, that means somebody is, how will I put it, managing somebody else's affairs in his absence. Estate belongs to all the belongings of somebody. It could be his assets and so on. So when somebody writes a will and said, I have will all my estates, you see, that is his belongings. So normally, somebody is creating a trust and somebody is getting settlements. Somebody is midwifing the settlement. That person is called the trustee. The trustee is the person who is having the trust and is enacting what the person who created that trust wants to get happened. Now, a trust, the basis period for that year is the preceding year basis. So preceding year basis is what is used in computing income of trusts to tax trust, settlements, and estates. So how do you do that? A trustee shall prepare accounts of income from all sources of the settlement or trust for successive periods to 31st December of each year. So it's as good as saying that for trusts, the account ending date will be 31st December every year, and it's going to be on preceding year basis. Now, let's say somebody dies who created a trust on June 1. The first account will be from June 1, when the person dies, down to December 31st of that same year. it will be calculated on preceding year basis. So if the person died in June 2010, it is in 2011 that they will start calculating the income and the tax for 2010 preceding year basis. So that is how it is going to be. Now, if they sell off all his estate, or we use the word dispose of all his estate in 2018, maybe it was fully disposed in August 31st, 2018. 2018 accounting period will be charged in 2019, preceding year basis. It will be from January 1 to the date August 31st that all his assets were disposed of and the accounts closed. Now, what are we going to do when we have a trust, settlement, and estate? There's nothing like commencement rule or cessation rule or change of accounting date. We are told that the account is always on 31st December. So we don't apply commencement rule, we don't apply cessation rule, we apply it as an ongoing business that the account ends in December 31st. Now, how do we calculate trusts, estate, and settlement? Look at this question. From this question, you will get the principle. Mr. Aqua created a trust for his 4 children, Ade, Barowa, Chidi, and Dafor. Now, because the trusts will benefit these 4 children, they are called the beneficiaries. The beneficiaries. The record of the trustee, so the trustee is standing for the business, is standing for the person who creates the trust. So the trustee is the one enforcing everything, acting on behalf of the person who created the trust. So perhaps Mr. Aqua have died and the trustee is acting on his instruction. And the records for the year ended December 31st, 2010. You see, that is 2020 year of assessment, 2011 year of assessment. The account will end in 2010 December. Now look at what it revealed. Profit from trading activities. So it means the estates include some trading activities. Then there are interest on fixed deposits that they received. Then they receive rent from property. You know, property rent is always collected, is always recorded gross. When you record rent, you record it as gross and not as net. Other income is all stated here. Okay. Other relevant information include, okay, therefore is to get a fixed annuity of 35,000. A fixed is just like fixed costs. So it means that every year this beneficiary is to get something fixed. So that it means the trustee is going to pay this money first from all the income before sharing the profit remainder to the people according to the profit sharing ratio. So that's a fixed amount, fixed annuity. It is stated, please give him this money. Perhaps that is what he's going to use to pay his house rent or pay his school fees, who knows. Now, remuneration of the trustee is an allowable expense. And now they said they're going to fix it at 20,000 naira every year. That's a fixed one, plus a variable sum of 2% of computed income. That means we have to look for computed income. and look for 20% of it, and 2.5% of it. That would be the remuneration. But you know, we must take away trustees' income and trustees' remuneration before we get computed income. So how can we calculate something? We are going to take away trustees' income or fixed remuneration before we get computed income. So how do we calculate computed income first and now get 2.5%? It's a dilemma, because we are supposed to know the total income before we get the computed income, total remuneration before we get the total income. So we'll use a method which I will show you. Then the allowable expenses of the trustee, they wrote it allowable expenses of the trustee. That means you are free to deduct this 25,000, it's allowable. Then the trustee made discretionary payments. Now, these discretionary payments are not allowable payment. These are what will I call it now? Disbursement from share of computed income. So these discretionary payments cannot come before the computation of computed income. You must find computed income first before you give out discretionary payment. Then you give out capital allowance. Then you share the remaining one according to the profits, according to the settlement ratio. So you see, look at the allowable expenses, fixed annuity, remuneration. There are two here, and that of the trustee. Okay, we are calculate the settlement chargeable to tax in the hands of each of the beneficiaries. Now look at it now. Each of the beneficiaries will be getting things as the trustee is giving them out. For example, when Dafoe gets this stance, okay, when Dafoe also gets this 15,000 naira, it's also going to be taxed in his hands. And when Dafoe received his share of net distributable income, these three things are going to be taxable in his hands. So how do we get the income, total income that is taxable in the hands of each beneficiary? Okay, so let's okay. Now can you see what we did? We have this total here represents what the trustee is doing. It represents the trustee's business. Look at the four beneficiaries. This is what the account represents. We were given profits from trading activity, which is this, 980. We have capital allowance agreed for the business of the trustee. So business goes to trading activity. So we less the capital allowance straight from the trading activity. And it gives us this figure. The next thing again, we have receipt. Okay, let's proceed. Okay, we looked at the allowable expense of the trustee. The allowable expense is 25,000, so it doesn't go to any of the beneficiaries because this is what the trustee spent in his business. We now come to the matter of the salary or remuneration, because we jumped it before. We wanted to do it last. The reason computed income. So that is why we are doing remuneration last. So look at what we'll do. The remuneration of the trustee is fixed at 20,000. So remuneration of trustee, we have the fixed one, which is still 20,000, is going off the business. Then that of the variable, they say is 2.5% on computed income. How can we get computed income when computed income is what we want to derive? All we need to do is this. First of all, since this is 2.5% of computed income, that means before we have deducted this variable remuneration, all other income have to be deducted. So what we are doing is this: 2,011,000 is this one here, minus this 35,000, minus this 25,000, minus this 20,000. All of them, when you minus it, the remainder is as good as saying is 102.5% of the computed income. So what do you do? Since they gave us 2.5%, you will say 2.5 divided by 102.5 is as good as adding that 2.5 to 100. You say 2.5 over 102.5 times the difference between this gross income and all this other income. Anything you get to give it 47,089. So let's do it together so that you understand what I'm saying. 2,011,000 minus 35,000 minus 25,000 minus 20,000 is going to give you this amount, 1,930,909. You look for times 2.5 divided by 102.5. So you see, it's giving us 98. So that is how we come about that 47,098. This is the variable remuneration of the trustee. So when you now if you now put it in bracket here and you perform all this calculation, this minus this minus this minus this new one, you're going to get this, which is your computed income. Now I want us to do a little test. If we have to look for 2.5% of this, we are going to get this figure. Let's try it. 2.5% of 1,883,902. 1,883,902. What happened? Our calculator is coming up. Okay, while our calculator is coming up, you just know that if you look for 2.5% of this figure, it will lead us to the remuneration. Okay, 1,883,902 times 2.5 divided by 100, that is 2.5%. So can you say that it gives us 47,098 naira, which is the 2.5% I just told you. Now, after getting your computed income as this, the next thing to do is to look at your discretionary payments. You look at your discretionary payments. The trustee made discretionary payments. So you look at it, you add them up. 40,000 plus 30 is going to give you 70. 70 plus 20 is going to give you 90. 90 plus 15 is going to give you 105. So the discretionary payments are 105. Going out from the business or the trustee and entering into the hands of the beneficiaries. So when you less it from this, your distributable income. So this is what you are going to distribute as your income. just hope that we can finish this class before the next network throws me out. Okay, so let's see. Now we said half of this distributable income is going to be shared equally to all the beneficiaries. So what I did, I looked for half of this amount. That half is what I put down here. It is this half that we are sharing equally. Now, how did I share the half? Since there are 4 people, I am sharing this half of it by 4, and this is what I'm getting. So the best way of doing it is look for half of this, then divide by 4. When you get 222,363, you put the 222,363 all across board. Then you add them up to get this. Or another way is when you get this 222,363, you multiply by 4. You would have gotten this figure here. So that is how I did it. And what happens? The A part of the question says income in the hands of the beneficiaries. So income in the hands of the beneficiaries is all these things that you have been given to the beneficiaries. This 40,000 plus this 222,363. This is the income at the hands of this man here. This one is the income at the hands of this. This last one is the income in the hands of Dafoe. Remember, he was given fixed annuity, then he was given discretionary payments, then it was decided he will get the same equal share of income. Now, the B part of the question, the amount of undistributable income in the hands of the trustee. So because we have distributed half to the beneficiaries, the remaining of the half will be in the hands of the trustee. So when you say this minus this half you've shared, is going to remain half in the hands of the trustee. So that's how we are going to look at the income from trust, unit, and settlements. I think we want to stop here for tonight. I'm going to send you the questions, the materials now, so that you can look at it and also look at the second question that we'll be discussing that was being discussed. It's still the same method. So you look at the examples. The network is so bad here. Don't want the network to throw me off again while we are starting it. So thank you so much for patiently paying attention